Everyone thinks empires collapse because they lose wars. Rome, Britain, the Soviet Union. The story is always the same. A great power overextends, meets a stronger rival, and falls. But that's not really how it happens. Military defeat is just the funeral. The real death happens quietly, decades earlier, in the balance sheets, behind the walls of central banks, and inside the logic of compound interest. Empires are not destroyed by enemies. They are eaten from within, by debt. The United States is not at war with a foreign invader. Washington still commands the most powerful military ever built. The dollar still underpins global trade. But the numbers tell a different story. In 2023, U.S. federal debt passed $33 trillion. In 2024, it cost over $1 trillion just to pay the interest. Not the principal, just the interest. That's more than the defense budget. And yet, nobody panics. The stock market hits new highs. Inflation is under control. The Fed speaks in calm tones, and the public believes them. That's how this phase always looks: calm, sophisticated, orderly, until the math breaks the illusion. Because we've seen this cycle before. It's not new. It's not even American. In fact, it happens almost like clockwork, every 70 to 90 years, to every great financial empire. Britain in 1914, France in 1789, Spain in the late 1600s. They all reached a moment where the numbers became unsustainable and the politics followed the money off a cliff. They said it was revolution, or war, or bad luck. But behind every turning point in history, there's always the same hidden pattern: rising debt, falling productivity, and a desperate attempt to hold together an empire with paper promises. And here's the paradox. The very tools that make a country powerful, credit, central banking, global trade, are the same ones that destroy it when abused. Just like oxygen feeds a fire, easy money feeds imperial ambition, until the fire burns too hot. If you're hearing this in 2025, know this: the math is already in motion. The numbers don't lie, and they don't care who's in office. Comment where you're watching from, and tell me, does this feel like the peak or the edge? The cycle always begins with genius, a new system, a bold idea, a country at the height of its confidence, not afraid to bet everything on the future. For the United States, that moment was 1944. The world was still at war, but American officials were already building what would come after it. At a quiet resort in New Hampshire, 730 delegates from 44 nations met to design a new financial order. What they created was called Bretton Woods. But it wasn't really a meeting, it was a coronation. America held 2/3 of the world's gold reserves. Europe lay in ruins. The dollar became the global anchor, not because of kindness, but because no one else could afford the job. Every other currency would now peg itself to the dollar. And the dollar? It would be backed by gold at $35 an ounce. This wasn't charity, it was control. If everyone needed dollars to trade, then the U.S. could print the world's reserve currency and run deficits other countries couldn't. For the first time in history, a single nation could export paper and import goods, while others had to earn their way. But every system needs an enforcement mechanism, and this one had two. The first was the Federal Reserve, the lender, the printer, the invisible heart of the machine. The second was debt. U.S. Treasury bonds became the safest asset on earth, the foundation of pension funds, foreign central banks, and corporate reserves. This is where the modern debt cycle begins, because debt in this system isn't just a tool, it is the system. After 1945, Washington spent trillions it didn't have, first on war recovery, then on highways, housing, and Cold War expansion. But there was always a buyer, the world itself, hungry for dollars. Foreign central banks bought U.S. bonds. Wall Street traded them, the Fed managed the rates, everyone was locked in, and the engine ran smoothly. For a while. But here's the catch. Debt is easy to start and almost impossible to stop. Once a government discovers it can spend more than it taxes without immediate pain, it always escalates. Britain did this in the 1700s. It used the Bank of England to fund its wars against France. The paper money worked until inflation destroyed the silver-based economy. France copied the idea with assignats, paper backed by land. It inflated its way through the revolution. The money died. The regime followed. Every empire thinks it can control the mechanism better than the last, but the structure is always the same. First, a central bank tied to the state. Second, a currency used beyond its borders. Third, an elite class of financiers and creditors who grow rich from debt issuance and war. That is the invisible triangle: the Fed, the Treasury, the bond market. It looks stable until the interest payments exceed the growth. Which brings us back to the United States. By the 1960s, France, under de Gaulle, saw what was happening. American deficits were piling up. Dollars flooded the world, but the gold that backed them was disappearing. France demanded its gold back. Germany followed. The U.S. tried to stall. It couldn't. On August 15, 1971, Nixon ended the gold standard forever. No more $35 an ounce, no more conversion. The dollar became pure fiat, backed not by metal, but by military, trust, and habit. The global system had now shifted from a gold standard to a debt standard. And once you understand that, you see the trap. Because now, debt must grow, or the system collapses. The economy no longer expands from productivity alone. It expands from credit. If the borrowing stops, the GDP stalls. If the interest rates rise, the debt explodes. There is no reverse gear. So here we are, in a world built on promises, where every downturn must be met with more stimulus, more issuance, and more paper. They built it in 1944 to stabilize the world, but they also built a machine that needs infinite fuel. And if you're wondering why the Fed keeps printing, why deficits no longer shrink, and why the U.S. debt ceiling rises every few years, it's not because politicians are stupid. It's because the system demands it. It felt like magic. America could borrow without saving, consume without producing, and pay with dollars that cost nothing to print. And the world accepted it, even wanted it. From the 1980s onward, debt became the new engine of prosperity. You didn't need gold anymore. You had treasury bonds. You had credit cards. You had Wall Street. People called it innovation, deregulation, globalization. But beneath the surface, it was something older, simpler, and more dangerous: leverage. Every boom in history has a narrative. In the 1990s, it was the peace dividend. In the 2000s, it was the tech revolution. After 2008, it was the recovery. After 2020, it was resilience. But behind every boom was the same accelerant: debt. The U.S. national debt grew from $1 trillion in 1980 to $5 trillion by 2000 to over $30 trillion today. Corporations leveraged up to buy back their own stock. Consumers took on mortgages, student loans, auto loans, credit cards, all to keep spending. Why? Because the interest rates were low, and the Fed liked it that way. The illusion worked beautifully. GDP rose, stock markets soared, home prices never seemed to fall, until they did. But in the illusion phase, no one cares, because every crisis seems fixable. 1987 crash, inject liquidity. Dot-com bubble, cut rates. 2008, bail out the banks. 2020, print trillions. The result? A generation that doesn't fear recessions. It expects bailouts. This is the real psychological shift of the debt cycle. It's not just in policy, it's in people. When money becomes easy, promises become cheap. And when interest rates stay near zero for too long, capital stops flowing to what's productive and starts chasing what's speculative. That's how we ended up with unprofitable startups worth billions, empty skyscrapers priced as assets, meme stocks, NFTs, zero-down mortgages, again. The same delusion wearing a different outfit. In the illusion phase, the future is always priced higher. More earnings, more growth, more tech. But nobody asks the oldest question in finance. Where is the yield coming from? The answer is debt. Always more debt. The U.S. doesn't create wealth anymore. It creates claims on future wealth. IOUs, securities, tranches, derivatives. It wraps them in legal language, sells them to pensions, and calls it value. But it's just another layer of promises. They did the same thing in France, 1790. They printed assignats, backed by confiscated land. The early rounds worked. Prices stayed stable. The elites got rich. But each new issue diluted the last until faith collapsed. We're doing it now with treasury bonds. Print more, promise more, and hope someone keeps buying. The illusion holds as long as inflation stays tame and foreigners recycle their dollars into U.S. debt. But that's the catch. Every illusion needs confidence. The moment people question the promise, the whole structure trembles. And what about the winners? The banks, the asset holders, the political class that spends borrowed money without consequence. They love the illusion. They don't want it to end. That's why the bailouts come quickly. That's why the Fed always pivots. That's why the debt ceiling always rises. Because once the illusion breaks, it doesn't come back. But in this phase, everything still looks fine. The charts go up, the narrative sounds smart, the news reassures, and nobody wants to hear the math. Because the math is boring. The party is fun until the check arrives. There is a point in every cycle where the stories stop working. Not all at once, not with a bang, but with silence. A pause in the room when the numbers don't add up anymore. When investors stop believing, when lenders ask for higher interest, and when politicians finally realize they can't borrow their way out of the debt they already owe. For the U.S., that moment is approaching, slowly, then all at once. In 2024, the federal government paid over $1.1 trillion just in interest. That's more than the military, more than Medicare, more than almost every other item in the budget. And yet the debt keeps growing. Over $2 trillion in new borrowing every year, even in peacetime. But here's the part they won't say out loud. Most of that borrowing is just to pay for the borrowing. It's a feedback loop. The government issues new debt to pay off old debt and hopes that rates stay low. But in 2022, inflation broke the illusion. After decades of cheap money, the Federal Reserve was forced to raise interest rates. Fast. From near 0% to over 5% in less than 18 months. And that changed everything. Debt doesn't just grow, it rolls over. Old bonds mature, new ones are issued. And now, instead of borrowing at 1%, the U.S. borrows at 5%. Multiply that by $34 trillion, and suddenly you're spending trillions a year just to stand still. This is where politics meets arithmetic, and loses. Because now, every promise becomes impossible. You can't cut Social Security, voters will revolt. You can't cut the military, rivals are watching. You can't raise taxes enough, the economy is too fragile. So you do the only thing that works short term. You monetize. You print. Not directly, that would be too obvious. Instead, the Treasury borrows, the Fed buys the bonds, and the money enters the system. They call it quantitative easing, but it's just 21st century money printing. They did the same in Weimar Germany, in Argentina, in 1790s France. First, they deny inflation. Then they blame supply chains. Then they manipulate bond yields. Then they issue more paper. And eventually, the world realizes the promises are worthless. Already, cracks are forming. In 2023, Fitch downgraded U.S. credit. Foreign buyers, Japan, China, Saudi Arabia, are quietly pulling back from treasury markets. Not selling everything, but no longer showing up like before. Meanwhile, the Fed is trapped. Raise rates to fight inflation, and the debt implodes. Cut rates to help growth, and inflation returns. This is called fiscal dominance, when central banks no longer control money for the economy, but only to keep the government solvent. It's the end of independent monetary policy. The Fed becomes a servant of the Treasury, and from there, confidence unravels. That's when gold rises, Bitcoin gains attention, capital flees into hard assets, and people ask the question that ends every debt cycle. If the safest asset in the world isn't safe anymore, what is? The collapse phase doesn't always look like fire and panic. Sometimes it's just a slow bleed, currency devaluation, negative real yields, social unrest, budget gridlock. The system works until one day it doesn't. Rome's currency collapsed before its legions did. The British pound lost its reserve status decades before the empire fell. The same is now beginning for the dollar. It's not a conspiracy. It's not mismanagement. It's not even political. It's math, and math always wins. You're living in the aftermath, not the beginning. Every headline you read about debt ceilings, inflation targets, central bank meetings, these are not events, they're symptoms. The debt cycle already broke the system. What we're watching now is the attempt to keep the illusion alive. Let's look at what this means for real people, not just charts and budgets. When a government spends more than it earns year after year, someone has to absorb the difference. In theory, that's investors. But in practice, it's you, through inflation. Inflation is the quiet tax, the one nobody votes for, the one that doesn't show up on your paycheck, but shaves off your purchasing power month after month. It's not an accident. It's the only way to make the numbers work. Imagine owing $100,000 with no way to pay it. What do? You inflate the value of money itself. Turn that $100,000 into less by making each dollar worth 90 cents. That's what's happening now, not just in the US, but across much of the developed world. The numbers are clear. Between 2020 and 2022, the US printed nearly 40% of all dollars in existence. That's not a conspiracy theory. That's from the Federal Reserve's own balance sheet. And now you feel the cost at the grocery store, in rent, in education, in the quiet erosion of the middle class. This isn't just bad policy, it's systemic. Because once an empire enters the final stage of the debt cycle, it has only two paths: default or debase, and no democracy survives default. So the state always chooses debasement, the slow bleed. In Rome, they clipped the coins, melting silver and replacing it with copper. In the 1970s, Nixon severed gold. Today, it's digital, quiet, automated, but the outcome is the same. The currency weakens, the trust erodes, and people start to hedge. That's why central banks, the same ones who claim inflation is under control, have been buying gold at record levels. In 2022, central bank gold purchases hit their highest point in history. They know what's coming. That's why nations are settling trade in local currencies: China and Brazil, India and Russia. Why BRICS talk about alternatives to the dollar. Why oil, once priced only in dollars, is now slipping into other denominations. These are not sudden moves. They are slow exits. Exits from a system everyone suspects is unsustainable. At home, the effects are more subtle, but more painful. Real wages stagnate. Housing becomes unaffordable. Generational wealth gaps explode. A younger generation inherits debt and depreciating dollars, but no pathway to assets. Meanwhile, those closest to the money, banks, asset managers, government contractors, grow richer. It's not a flaw, it's a feature of late-cycle financial systems. Just like in 18th century France, the financial class rides the wave of expanding paper. Landowners, soldiers, merchants, they get paid in devalued notes. But the insiders, they convert early. They buy gold, they buy real estate, they buy influence. And when the collapse comes, they're the ones holding the real assets, while everyone else is left with IOUs that no longer buy what they used to. This is the modern echo of the ancient pattern, a system that promises more than it can deliver, sustained by confidence and brought down by arithmetic. And once confidence breaks, nothing, no speech, no law, no bailout, can restore it. That's why central banks fear not the bond market, but the public. Because once everyday people understand the game, once they realize inflation is not temporary and debt is not repayable, they begin to exit. They change their behavior, save in harder assets, spend earlier, trust less. That's when the cycle enters freefall. The US hasn't defaulted yet, but it's already in debasement. It hasn't collapsed yet, but it's already past the point of balance. The math guarantees the rest. Every empire tells itself the same story, that this time is different, that they are smarter than the last, that their institutions are stronger, their people more informed, their leaders more rational. But the laws of money don't care about intentions, they only care about balance. When the promises a system makes, in the form of debt, currency, and political programs, grow faster than the system's ability to deliver real value, collapse is not a question of if, it's just a question of when. You can paper over the cracks with stimulus. You can inflate away the past. You can even convince a generation that this is normal. But arithmetic cannot be deceived. A government can default in two ways: by not paying its debt, or by paying it back in worthless currency. Both have the same result: a transfer of pain from the state to the people. The real warning here isn't about numbers, it's about trust. Money only works because we believe it does. A dollar is just a piece of paper or a line on a screen. It has no value unless someone else believes they can exchange it for something real tomorrow. When that belief begins to fade, even slightly, the system starts to unravel. We've seen it before, in the Roman denarius, in the assignats of revolutionary France, in the German mark, in the Argentine peso, in the Zimbabwean dollar, and now in the quiet devaluation of the world's reserve currency. This isn't about doom, it's about cycles, debt cycles, power cycles, trust cycles. They all follow the same pattern: a rise through discipline and production, a peak through confidence and credit, a fall through delusion and decay. And the United States, like every great power before it, is now in the final act of that cycle. What comes next is not the end of the world, but it is the end of the world as we know it. There is no bailout for a reserve currency, no lender of last resort when the whole system is the borrower. The only path forward is to rebuild, with sounder principles, honest money, and limits that match reality. If you take away one thing from this, it's that empires don't collapse because of bad people. They collapse when they try to cheat gravity. And gravity, in finance, is real value, real income, real productivity, and real trust. Hold on to those, and you'll weather the storm.